In 2022, the stock market delivered one of its most brutal beatdowns in recent memory. The S&P 500 collapsed over 25%, tech stocks down more than 30%, trillions in wealth gone. Retirement accounts gutted, portfolios that took years to build wiped out in months. Now here we are approaching 2026 and something uncomfortable is happening. The same warning signs that flashed before that crash are starting to reappear. The same patterns, the same pressure points, the same dangerous energy building beneath the surface. But here is what makes this moment even more alarming. This time, the crash will not look exactly the same. It will not follow the same script. And that is precisely what makes it more dangerous. Because most investors are preparing for the wrong storm entirely. Stay with me, because what comes next could change how you protect everything you have built. And that shockwave was just getting started, because this was not random. It was not bad luck. It was a chain reaction, and every link in that chain matters. It started with inflation. In June of 2022, the Consumer Price Index hit 9.1%. That was the highest inflation reading in over 40 years. To put that in perspective, most economists and market analysts had been expecting inflation to stay around 2 to 3%. The models were wrong, the forecasts were wrong, and markets were completely caught off guard. When prices rise that fast across food, housing, energy and services all at once, it does not just hurt consumers at the grocery store. It sends a shockwave through every corner of the financial system. The Federal Reserve's response to that inflation crisis became the second major force driving markets into the ground. To fight inflation running at 9.1%, the Fed did something it had not done in modern history. It raised interest rates at the fastest pace anyone had seen in decades. Within a single year, the federal funds rate went from near zero to above 4%. That might sound like a technical banking detail, but the impact on stocks was immediate and brutal. Here is why it matters. When interest rates rise, the future earnings of companies become worth less in today's dollars. Investors use a process called discounting to value stocks, and higher rates shrink those valuations fast. Growth stocks and tech companies, which depend heavily on future earnings, were hit the hardest. The result was a broad and painful sell-off that touched nearly every sector of the market without exception. That is a devastating 25% decline that erased trillions in household and institutional wealth almost overnight. Layered on top of everything else, oil prices exploded to $133 per barrel, driven by the Russia-Ukraine war and tightening global supply. At the same moment, supply chains that had already been strained by the pandemic completely buckled under the pressure. Factories stalled, shipping costs surged, and businesses could not get the goods they needed to operate. These were not isolated problems. They were simultaneous shocks hitting an already fragile system all at once. Inflation, rate hikes, energy prices, and supply chain collapse all arrived together, leaving markets with no room to breathe. The repricing was fast and brutal. The S&P 500 fell from 4,796 all the way down to 3,577. Now here is where things get interesting, and where many investors make a dangerous mistake. 2026 is not 2022. Let us be clear about that. Inflation has cooled significantly, sitting around 2.4%. The Federal Reserve is no longer hammering the economy with back-to-back rate hikes. On the surface, that sounds like progress. It sounds like stability. It might even feel like the worst is behind us. And that feeling, that sense of relief, is exactly what makes the current moment so deceptive. Because just because the conditions are different does not mean the risks have disappeared. In fact, some of the risks building right now are harder to see precisely because they are hiding behind that false sense of calm. The danger in 2026 is not obvious. It is quiet, and quiet risks are often the most destructive ones. The answer is more unsettling than most people realize. The first major risk building in 2026 is energy. The conflict involving Iran has pushed oil supply uncertainty back into the spotlight, and oil prices are already hovering around $100 per barrel. If that number sounds familiar, it should. Spiking energy costs were one of the central triggers that made 2022 so destructive for markets. When oil gets expensive, everything gets expensive. Transportation costs rise, manufacturing margins shrink, and consumers feel the squeeze at every turn. That pressure feeds directly into inflation numbers. When a negative shock arrives, and one always eventually does, overvalued markets do not just dip, they collapse fast. Right now, the S&P 500's price-to-earnings ratio is sitting well above its long-term historical average. That alone should raise eyebrows. But when you look at the CAPE ratio, which stands for cyclically adjusted price-to-earnings and smooths out earnings data across a 10-year period to remove short-term noise, the picture becomes even more concerning. This ratio is currently sitting at an extremely elevated level, a level that has historically preceded periods of poor market returns. What does that actually mean for everyday investors? It means the market has priced in a nearly perfect future. Strong earnings growth, stable rates, no major disruptions. And by the time the market fully prices it in, the damage is already well underway. Even though the Federal Reserve has paused its rate hikes, interest rates are not low. The 10-year Treasury yield is sitting around 4.25%, and that number matters more than most investors realize. Think about what that means in practice. Businesses borrowing money to expand, hire, or refinance existing debt are paying significantly more than they were just a few years ago. Consumers carrying mortgages, auto loans, and credit card balances are feeling that same squeeze every single month. This is not a dramatic, headline-grabbing shock like a sudden rate hike announcement. It is quieter than that. It is a slow, persistent drag that gradually erodes corporate profit margins and reduces consumer spending power over time. That kind of pressure does not show up all at once. It builds. That combination is where the real danger lives. The danger in 2026 is not a carbon copy of 2022. It is a different mechanism entirely, and that distinction matters enormously for how you protect yourself. Here is the key scenario playing out right now. Oil prices are already sitting around $100 per barrel due to the Iran conflict. If they stay elevated or push higher, that energy cost filters through the entire economy. Businesses pay more to ship goods. Consumers pay more at the pump. Prices across the board start creeping upward again. This is a risk that deserves your full attention right now. Profit margins get squeezed from both directions simultaneously. Input costs rise while consumer demand weakens, and that combination directly crushes earnings. When earnings fall, stock prices follow. It is that straightforward and that brutal. This is not theoretical speculation. It is a well-documented pattern that markets have experienced before, and the conditions for it to happen again are quietly assembling right now in 2026. What makes this particularly alarming is the scale of potential damage being discussed among serious financial analysts. Some financial models are currently projecting a potential 20% downside scenario if an oil shock continues to play out over the coming months. 20% does not sound catastrophic until you realize it represents trillions of dollars in erased wealth. This is the part where most investors make their biggest mistakes, but not you, not after this. The first smart move every prepared investor makes is building a cash buffer, enough to cover 3 to 6 months of living expenses. It sounds simple, almost too simple, but this single step changes everything about how you respond when markets start falling. Here is why it matters so much. When a crash hits and you have no cash reserve, you are forced to sell investments at exactly the wrong time, when prices are already down. That forced selling locks in your losses permanently. But when you have that cushion sitting safely outside the market, you do not panic. You do not sell. You wait. You breathe. You let the storm pass without permanently damaging your portfolio. That cash buffer is not dead money. It is your financial armor when the market turns against everyone else. You are responding to where prices already are, turning every swing into a strategic advantage. First, diversification, and not in the way most people think about it. Owning 20 different tech stocks is not diversification. True diversification means mixing assets that respond differently to inflation and growth environments. Think energy commodities, treasury inflation-protected securities, international equities, and real assets alongside your core stock holdings. When one area gets hit, another holds or even rises. The third move is disciplined rebalancing. Most investors treat volatility as something to survive. Smart investors treat it as a tool. The fourth move smart investors are making right now is aggressively eliminating high-interest debt, and this one often gets overlooked during market conversations. Here is why it matters so much right now. With interest rates still sitting at elevated levels, carrying expensive debt like credit cards charging 20 to 24% annually is not just uncomfortable, it is financially destructive. Think about it this way. If the market returns 7% this year, but you are paying 22% interest on debt, you are losing ground every single month. Paying off that debt is essentially a guaranteed 22% return, something no stock can promise you. And the timing matters even more during potential downturns. When markets fall and financial pressure builds, that debt compounds against you fast. Eliminating it now removes one of the most dangerous variables from your financial picture, giving you stability and breathing room exactly when you need it most. So here is where everything comes together. The 2026 market may not crash in the exact same way as 2022. The triggers are different, the environment has shifted, and the path downward could look nothing like what we saw before. But that does not mean the risks are not real. They are real, they are building, and they are being ignored by too many people right now. The investors who got hurt the most in 2022 were not the ones who lacked information. They were the ones who lacked preparation. They panicked when prices fell, sold at the worst possible moment, and locked in losses that took years to recover from. The investors who came out ahead were the ones who had already built their cash buffer, diversified properly, rebalanced with discipline, and cleared their high-interest debt before the storm arrived. Preparation is what separates panic from profit. Subscribe and let us navigate this together, because what comes next on this channel is where things get really specific. We are not just going to keep talking about risks in the abstract. Upcoming videos will walk you through exactly how to position your portfolio, asset by asset, step by step, so that whether the market drops 10% or 30%, you already know what to do before it happens. No panic, no guessing. Just a clear, prepared strategy built around what the data is actually telling us right now in 2026. The investors who come out ahead are never the ones who reacted fastest. They are the ones who prepared earliest. You have already taken the first step by watching this far.